I have clients that have gotten denied for mortgages because they don't know this credit card finesse. Now, although their credit cards are paid off, they still, or a lot of people don't understand how getting a mortgage works, even with paid off credit cards. Now, when you buy a home and you use, for example, an FHA loan, which is a 3.5% down loan, you have something called ratios, debt to income ratios. Let's just say, for example, your debt to income can't be above 50% of your income, including the mortgage price. This is something that I see all the time where people get denied completely, or they get pre-approved for a very small amount because they don't understand how credit cards play a role in your debt to income ratio. So here's the play. Let's just say, for example, you carried a balance in the past that was $10,000, right? And the minimum payment on that $10,000, let's just say, for example, was $400. So you carry the balance and your next bill say, hey, you have to make a minimum payment of $400, okay? You then go and completely pay the credit card off. You had $10,000 saved up, or you did something to make $10,000 and you completely paid the credit card off. And then you apply for a mortgage. When they run your credit and line all of your debt up, so here's your car payment, here's a loan payment, and here's your credit card payment. Although you've paid that credit card off, that $400 will still show as a debt, as a monthly debt. And this is something that a lot of people don't know. So when I work with clients and people that are reaching out to me for buyer consultations and they want to apply for a mortgage, I tell them, hey, if you have a credit card balance, that's fine. That doesn't mean that you'll get denied, especially if you have a very high income. But if you plan to pay your credit card off, don't do it. Here's what you do. Instead of paying it completely off, if you have a very high balance, pay it down to $50. Carry a $50 balance or $20 balance, because it will then reset on your credit report that now your minimum payment has gone from $400 to $25 or $50. And that changes the game for a lot of people, because now you have that extra $300 or $350 that can be added back to the monthly amount that you can afford to pay on the mortgage. So it reduces your debt to income ratio. And I learned this when I bought my first home. I paid my credit card off, and the lender was saying, although it's paid off, you see right here where it shows your minimum payment is like $125. And I'm like, well, it's paid off. So, it's paid off. And they said, well, we still have to use it as a monthly payment because it's showing on your credit report. And this isn't a standard that we can necessarily break. So this is one thing that I see all the time. So, if you're in the market to buy a home, or you plan to buy a home, pay the credit card down to $50 or $25. It could be $100, but you want to get that. You want that minimum payment. You want the credit card to cycle, hit your credit report to show that you have a very small payment, and that small payment will look a lot better and will reflect a lot better towards your debt to income ratio than that $400 payment. Although you pay the credit card off, that high payment is still going to show up. And once you add your car note, if you have one, or if you have any other personal loans or student loans, it can completely push you out of the real estate market. So I just want to just bring you all that small piece of information that can have a big impact on your future and your pre-approval.